Normally, a completely fractured supply chain is, an absolute disaster for a global business.
Right, yeah. Almost always.
But right now, in the pretty volatile world of maritime shipping, the fact that the global supply chain is fundamentally broken is exactly what's driving this massive, unprecedented surge in profits.
It really is.
And so, look, if you are a financial analyst or maybe a portfolio manager or, just an investor building out your models for the second half of the year, you cannot simply extrapolate past performance here.
No, you'd get the forecast completely wrong if you did.
Exactly. You really have to understand the mechanics of what is essentially an artificial capacity squeeze.
Yeah.
So today, we're taking a deep dive directly into the ledger for precious shipping.
Yes, looking at their Q2 2026 newsletter.
Right. To understand the hard data behind this market,
Mm-hmm.
because it's a fascinating time.
It is. And, the data in that ledger really reflects an environment that is just unseasonably, wildly strong. The newsletter actually refers to the dry bulk shipping industry right now as experiencing the year of the fire horse.
The year of the fire horse, I love that phrasing.
Right. It's very evocative. But as risk analysts, what we really need to grasp here is that this profitability, it isn't happening in a vacuum.
No, not at all.
It's happening directly because of some really intense global crises. I mean, we are looking at a market shaped entirely by the severe geopolitical conflict in the Middle East.
Specifically around the Strait of Hormuz.
Exactly, yes. And that is colliding with these massive structural economic shifts over in China.
Well, let's actually talk about how those macro shifts translate directly to the bottom line.
Yeah.
Because the year-over-year swing for precious shipping, or PSL, it's jarring.
It really is.
We're doing a really rigorous comparison here.
Yeah.
So in Q2 of 2025, PSL posted a net loss of $1.32 million US.
Yeah.
Fast forward exactly 1 year to Q2 2026, and they're posting a net profit of $15.87 million.
I mean, that is a profound shift in unit economics.
It's huge.
And, just to put that in local currency, for those of you who are modeling in Thai baht, that's moving from a roughly 43.31 million baht loss in Q2 of last year to a 521.50 million baht profit in Q2 2026.
Wow. And if we zoom out, just to look at the first half of the year as a whole, it's the exact same story.
Yep, the trend holds up perfectly.
A 183.55 million baht loss in the first half of 2025 flips entirely to a 629.68 million baht profit for the first half of 2026.
That's just a massive turnaround.
It is. But net profit can sometimes be muddied by accounting adjustments, right? So I want to look at the actual operational cash generation.
Sure. And for that, we look straight at the EBITDA.
Exactly.
So the EBITDA jumped from $13.34 million in Q2 2025 to a really impressive $30.38 million in Q2 2026.
More than double.
Right. And that delta, that tells you that the core day-to-day business of operating these vessels is generating significantly more cash.
And we can see exactly where that cash is coming from when we break down the TCE, the time charter equivalent rates.
Yes, the TCE is the crucial metric here.
Right. And for anyone who might be newer to maritime models, TCE is basically the daily revenue a ship generates after you strip out the voyage expenses.
Exactly. It levels the playing field so you can compare voyages.
Right. So the fleet average for PSL in Q2 2026 was $16,676 per day. But the breakdown by asset class is what really caught my eye.
Oh, absolutely. Because the dry bulk fleet, that averaged $16,442 per day.
Which is high.
Very high. To give you context, in Q2 of 2025, they were only getting $10,132 per day.
Wow.
Yeah, so that is a massive premium being paid for cargo space right now.
Right.
And then, you look at the sole tanker in their fleet, the Naree, that vessel pulled in an incredible $25,972 per day.
Okay, but here's where I need to push back on the ledger a bit.
Yeah.
Because I'm looking at the cost structure here, and there's a bit of a disconnect.
Okay, what are you seeing?
Well, if their top line daily revenue is jumping this high, why are their daily operating expenses, the OPEX? Why is that creeping up simultaneously?
That's a very fair point.
Because the OPEX for the dry bulk fleet rose to $5,676 per day, which is up from $5,135 a year ago.
Right.
That's roughly a 16% rise in vessel running expenses when you look at it in BATA terms.
Yep.
And the tanker OPEX is even higher, sitting at $6,434 per day. So What is driving that specific increase? Because it outpaces standard inflation by a lot.
It really does. And it's a critical question for your margins. That higher OPEX is driven primarily by two major factors:
Sure.
volatile bunker prices and some really severe non-recurring expenses.
Ah, okay.
See, when global choke points close, ships are forced into these massive detours. Detours mean they're burning significantly more bunker fuel.
Right, because they're traveling so much farther.
Exactly. But it also means they are operating in higher risk environments, which drastically spikes insurance costs.
The war risk premiums,
Exactly. Specifically, the additional war risk premium.
which means those, quote-unquote, non-recurring expenses on the spreadsheet, they're actually direct financial reflections of the crises happening out on the water.
Very much so.
Let's look specifically at the geopolitical impact on fleet operations in the Strait of Hormuz, because the source material outlines two major incidents involving PSL's fleet that really illustrate this risk.
Yes. The first one is the Mayuree.
Right.
On March 11, 2026, while it was exiting the Persian Gulf, the vessel was struck by two projectiles.
Which is just terrifying.
It suffered severe damage, and, while 20 crew members were safely rescued, tragically, 3 Thai crew members lost their lives.
Yeah. It's a deeply sobering reminder of the actual human cost behind these supply chains.
It really is.
From a strictly financial reporting perspective, though, how does a company model an event like that?
Well, the vessel was declared a constructive total loss.
Okay, meaning what exactly?
In insurance terms, that means the cost to repair the ship exceeds its insured value, so it's simply treated as a total loss.
Got it.
So the financial ledger for Q2 shows $10.98 million received in war risk insurance proceeds, and that's offset against $1.26 million in related expenses.
Okay, understood. And then there's the operational nightmare of the Hatthaya Naree.
Yes, a totally different kind of headache.
According to the newsletter, this ship was stranded inside the Persian Gulf for 2.5 months.
Just sitting there.
Just sitting there.
Well, free.
Fully crewed, burning fuel, quote, on the company's account, meaning he was generating absolutely zero income.
Nothing at all.
Just waiting for safe passage to exit the Strait of Hormuz. I think it was finally fixed on a time charter on June 24th, but as of the reporting date, it remained in the region pending safe transit.
Right. And this is exactly where we see the mechanism of what industry analysts call ton-mile distortion.
Ton-mile distortion. Okay, explain that.
Because the Strait of Hormuz is effectively restricted for normal commercial traffic right now, the entire global logistics network has changed.
Right.
The old era of just-in-time supply chains, that's completely dead. We are now firmly in an era of just-in-case logistics.
Just in case, I want to make sure I'm fully grasping the mechanism here, so let's use an analogy.
Sure, go for it.
Think of the global shipping fleet like a massive fleet of city taxis.
Okay.
If a major bridge in the center of the city collapses, every single taxi trying to cross town has to take a 40-minute detour around the river.
Right.
So suddenly, even if the actual number of passengers in the city hasn't changed at all, you can't find an available cab anywhere.
Because they're all stuck in transit.
Exactly. All the taxis are occupied just driving the detour, so surge pricing kicks in across the entire city. Is that basically what we're seeing with freight rates?
That is a brilliant way to conceptualize it, actually.
Oh, thanks.
The passengers in this case are cargoes of, fertilizer, sulfur, and food coming out of the Middle East. And because they can't take the bridge, so to speak, they are taking massive detours around the Cape of Good Hope, or they're utilizing these incredibly convoluted land and sea routes.
Which eats up time.
Exactly. That longer travel time artificially absorbs the global vessel capacity. You literally need more ships to carry the exact same amount of cargo because every single trip takes twice as long.
Which brings up a fascinating paradox. You have ships stuck, sitting idle for months, or tragically being destroyed, and yet the effective reduction in global supply means the ships that are operating are commanding such a massive premium that the company as a whole swings to a $500 million Baht profit.
Yeah.
It's really the grim economics of maritime risk.
Exactly. I mean, when 10% of the world's fleet is stuck or taking a massive detour, the buyers of commodities still need their raw materials.
They don't have a choice.
Right. They just have to outbid each other for the remaining available ships.
So that perfectly maps out the supply constraint side of the equation.
Yeah.
But let's pivot to demand, because historically, if you want to understand dry bulk demand, you just look at China.
Always.
And I have to admit, I'm looking at these numbers and I am genuinely confused.
How so?
Well, it's super well documented that China's property sector, the engine that usually drives their economy, is in a prolonged, massive slump.
Sure.
If they aren't building apartments, then nobody needs steel and nobody needs iron ore. Rates should be collapsing,
Oh,
but they aren't. So what is going on with the commodities trade?
you are highlighting the most important structural shift in the global economy right now, hands down.
Really?
Yes. To understand why demand is remaining so stubborn, we have to look at China's import numbers for the first half of 2026.
Yeah.
The newsletter references an analysis titled, Can China Grow from Within?
Okay.
And the answer is that their economic model is aggressively pivoting
Pivoting to what?
to high-tech manufacturing, electric vehicles, and massive energy security stockpiling.
Oh, wow.
Right. The old model of investment-driven, property-led growth has pretty much reached its limits. But the new model is just as raw material intensive, just in entirely different ways.
Okay, let's look at the actual data to back that up then. In the first half of 2026, China imported 628.9 million metric tons of iron ore.
Which is massive.
It is. That is actually up 6.2% year over year. Where is all that steel going, if not into high-rise apartments?
It's going into infrastructure, massive shipbuilding programs, and the physical grid required to support their entire energy transition.
Interesting.
And speaking of energy, let's look at coal. Imports hit 225.4 million metric tons, which is up 1.7% year over year.
And the mechanism behind that coal number is fascinating, too. The newsletter points out this was driven by severe heat and an El Niño weather pattern.
Yep, extreme weather playing a huge role.
Basically, they had a severe drought, the hydropower reservoirs dried up, and to keep the air conditioners running and the factories online, they had to rely heavily on coal-fired power.
Yep.
And when domestic coal isn't enough, they have to import it, which immediately absorbs dry bulk shipping capacity.
And we also really have to look at the agricultural and minor bulk sectors.
Right. Soybeans saw a massive Q2 surge, jumping to nearly 34 million metric tons as China actively rebuilt its U.S. imports.
Yeah.
But the number that really jumps off the page to me is bauxite. Guinea's bauxite exports hit an all-time record of 114.8 million metric tons in the first half of the year.
It's an astonishing figure.
That is up 15% year over year.
And bauxite is the perfect example of this structural pivot we're talking about.
Because of aluminum.
Exactly. Bauxite is the raw material used to make aluminum. Electric vehicles require exponentially more aluminum than traditional internal combustion cars to offset the heavy weight of the batteries.
Of course.
So while the property sector shrinks, the booming EV manufacturing sector is creating a massive, sustained draw on global bauxite.
Yeah.
And that has to be shipped halfway across the world from Africa to China.
Okay, so if we synthesize this for our models, China's tech and green energy pivot guarantees the demand for raw materials isn't going anywhere anytime soon.
Correct.
And simultaneously, the Middle East crisis guarantees that voyages to deliver these materials are taking twice as long.
Yes.
If you are a ship owner, your immediate thought has to be, well, I need to buy more ships right now.
That's the logical conclusion.
So let's look at the supply side and fleet dynamics. Are there reinforcements coming? Is there a massive pipeline of new vessels about to hit the water that will ultimately crash these high freight rates?
The short answer is no.
No.
The reinforcements simply aren't there. And understanding the math behind why is crucial for projecting the next few years of this industry.
Okay, lay out the math for us.
We start by looking at the order book to fleet ratio.
Which is the percentage of new ships currently on order at the shipyards compared to the active fleet on the water.
Exactly. Right now, that sits at just 13.18%.
And that feels incredibly low for an industry experiencing a massive boom in profitability. Why aren't they building more?
Because the shipyards are already full.
Ah,
During the pandemic, there was a massive rush to build container ships and LNG carriers. The shipyards are totally booked solid with those orders, meaning dry bulk owners are effectively at the back of the line.
wow, okay.
But even that 13.18% doesn't tell the whole story. You have to compare it to the aging profile of the existing fleet.
Right.
Right now, 12% of the entire global dry bulk fleet is over 20 years old.
Ah, I see exactly where this is going. So basically, almost every single new ship coming off the assembly line over the next few years is just going to replace an aging 20-year-old ship that is heading to the scrapyard.
Precisely. The net supply growth for the industry is projected at roughly 3.9% for 2026.
Okay.
But if you are an analyst, you cannot use that 3.9% in your model.
Why not?
It is highly misleading because it completely ignores regulatory constraints that are actively artificially shrinking the fleet's capacity as we speak.
You're talking about the IMO's environmental regulations.
Yes.
The EEXI, or Energy Efficiency Existing Ship Index. Explain the mechanism here. How does an environmental regulation shrink the supply of ships?
Well, to comply with EEXI carbon emission targets, older ships have to implement engine power limits, or EPL.
Engine power limits.
Yes, they literally have to physically cap their engines so they cannot burn as much fuel. For PSL's specific fleet, this regulation forced an average 1.6 knot speed reduction on all of their non-eco ships.
Let's do the math on that for the listener because it's important.
Yeah.
If a ship is forced to slow down by 1.6 knots, it takes days longer to complete a single voyage.
Exactly.
That means over the course of a year, that ship can complete fewer total voyages. According to the data here, across the entire global dry bulk fleet with non-eco engines, that mandatory 1.6 knot speed reduction effectively removes 3.6% of the global supply capacity.
It completely wipes out almost all of that projected net supply growth.
Wow.
And it compounds because on top of the EEXI speed limits, you also have to factor in special surveys.
What are those?
Special surveys are mandatory, incredibly thorough dry dock inspections that older ships must undergo to maintain their safety certifications.
Meaning they aren't on the water.
Right. You have to take the ship completely out of the water. And because we have such a large percentage of the fleet hitting that 20-year mark, the sheer amount of downtime required for these vessels to undergo their special surveys is projected to cause another 2.3% loss in geared bulker supply by 2027.
Okay, so it's like being on a massive, busy highway where commercial demand is surging and there's more cargo to move than ever.
Right.
But the government just lowered the global speed limit for everyone. And simultaneously, a huge percentage of the trucks have been pulled over to the side of the road for mandatory weeks-long safety inspections.
That's the perfect way to look at it.
Even if you manage to add a few shiny new trucks to the road, the total amount of cargo actually arriving at the destination drops.
That is exactly what is happening. And to adapt to this highly constrained reality, PSL is actively executing a fleet renewal strategy.
Yeah, the source explicitly notes they purchased a second MR tanker, the Hatthaya.
Right.
That's a medium-range vessel designed to carry refined products, which makes total sense, given the $26,000 a day their current tanker is pulling in.
Absolutely.
It's expected for delivery between August and November 2026. They are upgrading and diversifying their assets to navigate this exact environment.
It's the only way to survive these shifts.
So, bringing this all together for you listening, we've gone through the income statement. We've broken down the geopolitical risks stretching the routes, we've unpacked the Chinese demand pivot, and we've analyzed the structurally constrained supply of ships.
We've covered a lot of ground.
We have. So can you give us a rapid synthesis of what this actually means for the second half of 2026? If I'm managing a portfolio, what is the bottom line?
The bottom line is that the data points to a fundamentally robust dry bulk market for the foreseeable future. You have an environment supported by artificially constrained supply due to environmental regulations and an aging fleet. You have localized supply chains driving longer ton miles due to the Middle East conflict.
Right.
And you have surprisingly steady commodity demand driven by China's aggressive tech and energy transition. It is an incredibly tight market, and tight markets yield high premiums.
Which certainly explains that massive year-over-year profit swing to $500 million bonds.
It does.
Now, before we wrap up, just a quick housekeeping note for you listening. Please ensure you heed the safe harbor statement regarding forward-looking risks detailed in the PSL newsletter.
Very important.
Factors like global inflation, highly volatile bunker fuel prices, and sudden geopolitical shifts can alter these trajectories rapidly. Also, mark your calendars. The PSL earnings call will be virtually held on August 7th at 10:15 hours via the S&D Live webcasts.
It's a great opportunity to hear management discuss these exact Q2 results and push them on these models.
Absolutely.
You know, this entire landscape raises an incredibly important question, though, and it's a fascinating paradox to leave you with as you update your models.
Oh, what's that?
Consider the EEXI environmental regulations we just walked through. They were designed, quite nobly, to make global shipping greener and reduce carbon emissions.
Right, by forcing the older ships to slow down and burn less fuel.
Exactly. But by forcing ships to artificially slow down during a period of intense global demand and severe geopolitical crisis, these quote-unquote green rules are actively constricting vessel supply.
Which keeps rates high.
Yes. That constriction is a massive factor, keeping freight rates sky high and making the industry highly profitable right now.
I see.
And because profitability is so high, owners are heavily incentivized to pay for those expensive special surveys and keep their older, dirtier 20-year-old ships on the water for as long as possible rather than sending them to the scrapyard.
Oh, wow.
So the paradox is this. The very environmental policies meant to clean up the oceans are inadvertently funding the longest bull run for aging, high-emission ships in modern history.
That is absolutely wild. The policies designed to force the dirty trucks off the road are making freight so expensive that it's actually funding the repairs to keep them driving.
Precisely.
The global supply chain is fractured, and the green polish applied to it is actually extending the lifespan of the oldest vessels on the water.
It's quite the irony.
It is a massive structural irony, and definitely something you need to ponder as you forecast the capacity of this fleet for the second half of the year. Thanks for joining us on this deep dive.